IWF's extra 36% return looks tempting until you realize it crashed 7 percentage points harder when markets tanked. Worth the risk? Now let's shift gears and look at IWF's deeper 33% crash and a longer climb back, taking 453 days versus VV's quicker, 427-day recovery from 26%. But here's where it gets interesting. IWF's 124% three-year return is exceptional. That's elite performance, putting it among the top large-cap growth funds out there. Let's zoom in on this. VV's 88% three-year return is solid growth, but it's clear someone else stole the spotlight with more explosive gains. In plain English, over 3 years, IWF outpaced its competition by 36 percentage points. Think of it like race cars, same track, but IWF had a more powerful engine driving those returns. Here's where the story takes a turn. Over 5 years, IWF's returned 101%. Still strong, but you'll notice the performance gap starting to compress here. Let's break this down further. VV's 90% 5-year return narrowed the gap to just 11 points, nearly matching its benchmark over the long haul. In plain English, IWF's early sprint gave it the lead, but VV's steady marathon pace nearly closed the gap by the finish line. It's a perfect reminder that pacing strategies matter just as much as raw speed in investing. Now, for the real question. High returns mean nothing if you're losing sleep over wild swings. Risk-adjusted performance shows which funds earned returns most efficiently. In plain English, risk-adjusted returns are like a report card. 2 students get the same A, but one studied 3 hours while the other pulled an all-nighter. Same grade, completely different effort required. Here's where things get revealing. VV's winning here with a Sharpe ratio of 0.8. Solid returns without taking on excessive risk over the year. Now let's put this in perspective. IWF's Sharpe ratio of 0.7 shows it's converting risk into returns less efficiently. Not terrible, but there's room for improvement here. In plain English, think of the Sharpe ratio like mechanical leverage. The higher it is, the more return you're squeezing out of each unit of risk. More lift, less sweat. Here's the thing though. Over 5 years, both funds delivered identical risk-adjusted returns at 0.6, proving they're equally efficient despite their differences. Let's take a closer look. VV's Sortino ratio of 1.0 shows it's protecting your downside remarkably well when markets turn ugly. Now here's where it gets tricky. IWF's Sortino ratio of 0.9 means you're getting slightly less return for every unit of downside risk you're taking on here. In plain English, the Sortino ratio is like a roller coaster that only counts the scary drops, not the fun climbs. VV had gentler downside swings, meaning smoother rides when markets got choppy. Let's see how this plays out. Maximum drawdown shows where things really hurt. When markets crash, concentrated bets expose you to devastating losses you can't easily recover from. Here's what really matters. A 26% drop is definitely noticeable, but it's manageable for most investors, nowhere near a portfolio-ending disaster. Now, let's connect the dots. IWF's 33% crash really tests your stomach. That extra 7 points beyond typical drops separates investors who hold from those who panic sell. In plain English, maximum drawdown reveals who swims and who sinks. IWF took on 7 percentage points more water than its competitor during the same storm. That gap feels enormous when you're the one drowning. Let's unpack this a bit. That's 14 months watching your investment underwater before finally breaking even. Recovery time matters just as much as returns. Here's the key takeaway. Time to pick a side. Who's your winner, VV or IWF? Now, let's flip the script. IWF took 453 days to recover. An extra month of watching your money underwater adds real psychological stress. In plain English, IWF needed a whole extra month to rebuild after the shock, like a building crumbling in an earthquake. VV bounced back faster with less damage to its foundation. Let's get into the weeds here. Volatility is the real game changer here. Higher standard deviation means you're riding bigger waves, both up and painfully down. Now let's shift gears and look at VV's 17% volatility means moderate swings for a growth fund. Not exactly calm, but not wild turbulence either. But here's where it gets interesting. IWF's 22% volatility means wilder swings. That extra 5 points of standard deviation translates to a significantly bumpier ride for investors. In plain English, think of volatility like an amplifier knob. IWF cranks it to 22 while VV stays at 17. Higher volume means bigger gains when markets soar, but nastier drops when things turn ugly. VV's 5-point stability edge means fewer wild swings, making it easier to stick around when markets get brutal. Here's what's really creating these performance gaps: expense ratios, turnover rates, and how each fund allocates across sectors. Let's break this down further. VV's 0.04% expense ratio is ridiculously cheap. You're basically keeping everything you earn with fees this low. Now let's shift gears and look at IWF's 0.18% expense ratio costs you 4.5 times more than VV over time. That's a hefty premium you'll keep paying. In plain English, IWF's 18 cents versus VV's 4 cents per $100 might seem like couch change now, but over decades, that difference compounds dramatically, turning pocket change into thousands you'll never see again. Let's dig into the details. VV's 2% turnover means they're holding stocks for decades, not months. That's a true buy and hold strategy in action. Here's where things get revealing. IWF's 14% turnover is 7 times higher than VV's. That's significantly more trading activity and higher transaction costs eating into returns. In plain English, portfolio turnover measures trading frequency. VV commits long-term like loyal dance partners, while IWF switches 7 times more often. That frequent movement means higher friction costs eating into your returns. But here's where it gets interesting. Technology concentration isn't just a detail. It's the single biggest factor separating the winners from everyone else in recent years. Here's the thing, though. IWF delivered stronger returns at 124% over 3 years, but you're paying for that with 33% crashes and higher volatility. VV's smoother ride costs less and drops less. Let's take a closer look. VV's 35% tech allocation gives you solid sector exposure, while keeping enough room to diversify across other industries too. Now here's where it gets tricky. IWF is betting half its entire portfolio on tech. That's a massive concentration risk if the sector stumbles. In plain English, here's your tech allocation breakdown. VV serves you 3 slices of tech out of 8, while IWF dishes out 4. More tech exposure means higher growth potential, but you'll feel the pain harder when tech stumbles. Let's see how this plays out. That 16-point tech allocation gap between IWF and VV, it's the difference between flying high and crashing hard when tech moves. Here's what really matters. Fewer holdings in mega caps means bigger swings. Concentration amplifies both your wins and your losses in equal measure. Now let's connect the dots. VV spreads your money across 456 different stocks. That's some serious diversification protecting you within the large cap growth space. But hold on a second. IWF holds just 391 stocks. That's 65 fewer options to save you when your top performers decide to crater. In plain English, VV spreads your money across 456 stocks, while IWF uses just 391. It's the classic egg basket lesson. Fewer baskets means a single bad stock hits your portfolio harder. More diversification equals more cushion. Here's the key takeaway. VV's trading at a 22.6 PE ratio. That's pretty fair pricing if you're hunting for quality growth without overpaying. Now let's flip the script. IWF's trading at 29 times earnings. Investors are betting big money on future growth with this concentrated international exposure. In plain English, IWF is paying nearly 29 times earnings versus VV's 23 times. Think of it like the egg basket analogy. More eggs at risk means you're betting harder on future growth to justify today's price. Let's get into the weeds here. VV keeps 46% in megacaps, leaving room for mid-sized growers. A balanced bet that won't ignore tomorrow's giants. Now let's shift gears and look at IWF. Is heavily concentrated. Nearly 2/3 goes to mega-cap stocks. That's betting big on the market's absolute giants. In plain English, IWF's loading up on its 4 mega-cap champions all at once, while VV spreads the bet across different sized companies. It's like choosing between race cars built for pure speed versus a mixed garage with more agility. Let's zoom in on this. VV's price to book of 4.6 signals. Investors expect moderate growth ahead. Not bargain bin cheap, but not wildly overpriced either. Let's zoom in on this. IWF's commanding a 10.7 price to book ratio. Investors are paying more than double VV's multiple for these assets. In plain English, IWF's trading at 10 times its book value, while VV's at just 5 times. That's construction rising at work. Higher price to book means you're paying more premium over actual assets, leaving less room if things crumble. Let's break this down further. IWF's 124% 3-year surge comes from betting big on premium priced stocks. You're paying top dollar for explosive growth potential. High valuations mean brutal corrections. A 33% drawdown and 22% volatility prove expensive stocks crash harder when sentiment shifts. In plain English, here's the seesaw analogy. IWF's pricier stocks mean you'll soar higher when markets climb, but brace yourself for a rougher landing when they fall. VV rides a gentler swing. Let's dig into the details. VV's diversification across 456 holdings kept volatility at just 17% while still delivering 90% returns. Stability without sacrificing too much growth. Here's where things get revealing. IWF's betting big. 64% megacaps, 51% tech, just 391 stocks. That concentration delivered 124% returns, but expect 22% volatility swings. In plain English, IWF swings for the fences like a power hitter, striking out more often but crushing it when it connects. VV plays small ball, racking up steady base hits that consistently win games. But wait, there's more to this story. IWF dominates short term at 124% versus 88%, but VV's steadier approach nearly catches up over 5 years at 101% versus 90%. Here's the thing though, IWF's 124% return sounds tempting until you face that 33% crash. VV's smoother ride might actually help you sleep at night. In plain English, Here's the roller coaster truth. IWF is the wild triple loop that'll thrill or terrify you, while VV's the gentle glide everyone can stomach. Pick your ride based on your tolerance for chaos. That 0.14% expense gap seems tiny now, but it'll cost you hundreds of thousands over 30 years of compounding. But that's not the whole picture. Your choice here really comes down to your personal risk tolerance and what you're looking for in a portfolio. Let's see how this plays out. So, which ETF matches your style? VV for steady, patient growth, or IWF for maximum returns and maximum risk? In plain English, think of it like a road trip. VV's the smooth highway with steady cruising, while IWF is the mountain pass with steep climbs and sharp turns. Both get you there. Which matches your style? Now let's connect the dots. The standard disclaimer: do your own research, consult professionals, and invest responsibly always. But hold on a second. Want more ETF breakdowns like this? Hit subscribe for weekly deep dives that actually help you pick the winning funds.